Hey guys, welcome to week 11 of investment analysis. Today's topic is on debt securities. This is about a content on chapter 10 and chapter 11 of your textbook. In this session, we will be introducing the terminology and features of bond valuation. And we will also be talking about the pricing of bond. So far two things, bond characteristics and bond pricing. And thirdly, we would be quantifying the interest rate risk via the bond's duration or the bond's modified duration. And of course, we will be discussing about the determinants of interest rate risk. As for the practice session, we will be considering a few examples of bond pricing. So as we discussed in the beginning, the lecture is about the chapter 10 and chapter 11 content of the textbook. So chapter 10 is about bond prices and yields, and chapter 11 is about managing bond portfolios. So those are the reading materials this week. Now let's talk about bond terminology and characteristics. So actually first, let's define bond. What is bond? Bond is a security that obligates issuer to make payments to holder over time. And there are two important characteristics of bonds. One being the face value or par value, and the other being coupon rate. What is face value? It is the single lump sum payment to the bondholder at the maturity date of bond. And what is coupon rate? Coupon rate is the bond's annual interest payment per dollar of the face value. For example, if we think about this 3% annual interest rate, then such 3% annual interest rate is called as coupon rate. There are several categories of bonds. So there is zero coupon bond, which pays no coupons and pays only payment of par value at the maturity date. Such bonds will be sold at discount. Discount meaning that it is sold at a value that is lower than the face value. Now let's talk about callable bonds and puttable bonds. So callable bonds entails a right of the issuer to buy back its bond early. As for puttable bonds, it entails a right of the holder. So the holder would be the buyer to return the bond back to the issuer early than the maturity date. That's callable bonds and puttable bonds. Then let's move on to convertible bonds. So convertible bonds allow bondholders to exchange bond for a specified number of common shares. So it has the features of both debt and equity. Now move on to floating rate bonds. What are floating rate bonds? Those are the bonds that have coupon rates would periodically reset according to specified market rate. Now on to accrued interest and quoted bond prices. So what is accrued interest and how do we calculate it? Accrued interest is just the interest that has accumulated after last coupon payment, but this interest accumulated has not yet been paid. So how do we calculate it? It is just calculated as first we start with the coupon payment and then we divide it by the number of days between two coupon payments. This would lead to the daily coupon payment. And if we further times the number of days after last coupon payment, this is the interest payment that has been accumulated through this period. Um, and what is quoted bond prices? So quoted prices are the percentage price that are usually quoted on media. So, for example, we might say 117%, which is a quoted price. And this quoted price is actually a percentage of the face value, and such quoted prices do not include the interest accruing between payment dates. If we use a quoted price times the face value, we actually obtain the flat price, and the invoice price or the full price will be equal to the flat price plus the accrued interest. Now that's quoted prices. Now let's move on to a specific example of the accrued interest calculation. So here we have a bond with the following characteristics. So it has semi-annual payments and the coupon rate is 6%. You guys need to pay attention that the coupon rate is an annualized rate. So, and because we are faced with a bond with semi-annual payments, we have to like convert this annual coupon payment into semi-annual coupon payment. The face value is $1,000, and the number of days that have passed after the last coupon payment is 45 days. So to calculate the accrued interest for this particular bond, we start with the annual coupon payment of 60, like because of this 6%, and then we use 60 divided by 2. That leads to the semi-annual coupon payment of 30, and then we times actually, we first divide by the number of days separating the two coupon payments, which is 182 days. And then we times the number of days that has already passed, so which is 45 days. So that leads to the accrued interest in this question here, which is 7.42. Now let's talk about bond pricing. So bond value can be calculated as the present value of coupons plus the present value of face value. So it's essentially just the discounted cash flow models we learned about in previous lectures. Therefore, the formal formula for bond value is as stated in the first equation over here, where T is like where the uppercase T represents the maturity date, and this R here represents the discount rate. And alternatively, this first formula over here can be transformed into the second formula on this slide, and which actually means that the bond price is equal to coupon times an annuity factor with the parameters of R and T plus the face value times a PV factor. Again for the PV factor, the parameters are R and T again. Here is an example of computing bond prices. So we have two bonds, bond A and bond B. The maturity of bond A is 4 years, while the maturity of bond B is 30 years. The rest characteristics of these two bonds are the same. And we know that the coupon rate is 5% for both of the two bonds. And the discount rate is 8%, while the par value is $1,000. So we can actually calculate the present value of coupons for those two bonds denoted in the red circles here. and we can also calculate the present par value for these two bonds, denoted in the blue circles. As we can see, the present value of bond A's coupon is much lower than the present value of bond B's coupon. And this is just because bond B has more coupon payment occurring times because it has a higher maturity. And on the other hand, if we compare and contrast the present par value of those two bonds, we can find out that because bond A's principal payment is in the near future, while bond B's principal payment is far away. Therefore, the present value of bond A is much higher than the present par value of bond B. And as a result of that, actually bond A, despite it has a lower present value of coupons, its high present par value contribute to its high price. What are the determinants of bond pricing? So obviously the major determinant should be interest rate fluctuations. Why is that so? That's because if we look back to the bond pricing formula, we can find out that the price would decrease when the discount rate increases, because the discount rate actually increases with the market interest rate. As a result, the bond prices tend to fall when the market interest rate rises. And so this is just an inverse relationship between the price and the market interest rate, which can be depicted by this figure over here. And how would such interest rate risk be impacted by maturities? Let's take a look at the table over here first. So in the table, we can see that for the bonds with shorter maturity, their prices experience a lower reduction when the market interest rate increases from 2% to 10%. But actually, the 30 years bond experiences the highest reduction in prices when the market interest rate increases from 2% to 10%. So the 30 years bond is actually most sensitive to the interest rate changes. And we can further try to expand this observation by looking at the bond pricing formula. So if we look at the bond pricing formula we discussed previously, the longer maturity means that in this pricing formula we have higher uppercase T and also higher lowercase t. Let's focus on the second term, the discounted principal payment term. This term will obviously be more sensitive to a change in R with a larger uppercase T. The same actually applies for those discounted coupon terms. So in other words, the farther into the future the cash flows are received, the more their discount values and the price will be affected by the discount rate changes, and naturally the interest rate changes. For the discount rate we just talked about, if it would make the present value of bonds payment just being equal to the market price, then we call this discount rate as yield to maturity. So that's one type of bond yields. We also got another type of bond yield, and we call it as current yield. And current yield is calculated as annual coupon divided by the bond price. We also got another two concepts, one being the premium bonds and the other being discount bonds. So it's about the relationship between price and the face value. So for premium bonds, those are the bonds that are selling above the face value, so price greater than face value. For discount bonds, we have the price being smaller than the face value. What are the price trajectories of premium bonds and discount bonds over time? So the figure below gives a graphical example about the price trajectories. So in this figure, we have blue solid lines representing the premium bonds price, and we have the black solid line representing the discount bonds price trajectory. So as we can see from the figure, these two bonds have the same face value, and for the premium bond, it will start at the price that is higher than the face value, and as time goes by, its price will eventually converge to the face value at the maturity date. On the other hand, for the discount bond, its price starts at uh, at a position that is lower than the face value, and it finally converges to the face value at the maturity date. This is equivalent to say that the premium bonds are always going through capital losses and the discount bonds are always going through capital gains. And let's try to explain why would we be having discount bonds and why would we be having premium bonds, and what are the capital gains for and what are the capital losses for. So discount bonds are associated with low coupon rate. When the coupon rate is lower than the market interest rate, the coupon payments alone cannot provide investors as high as returns they could earn elsewhere in the market. And to receive a competitive market return on such an investment, investors also need some price appreciation on their bonds. So they need capital gains. And the bonds therefore must sell below the face value to provide a built-in capital gain on the investment. That's why we have the discount bonds. That's why we have the discount. And we have capital gains to just offset the low coupon payments so that the bondholder can receive a market return. And what about the premium bonds? So for the premium bonds, they are usually the bonds with high coupon payment. So if the coupon rate exceeds the market interest rate, the interest income by itself is greater than that is available elsewhere in the market, and the investors will bid up the price of these bonds above the face value. But one time, like as time goes by, when the bonds approach maturity, these bonds will fall in value because now there are less coupon payments left. So therefore, we have a decrease in the price, right? This results in capital losses, and the resulting capital losses would offset, so it will cancel out the large coupon payments so that the bondholder now again receives only a competitive rate of return that is just the same as a market return. To corroborate our previous argument, let's go back to the graphical example again. So if we look at the figure again, we find out that both of these bonds, the premium bond and the discount bond, they have the same yield to maturity rate. So both of them have YTMs of 8%. And yield to maturity actually measures the average return on revenue if the investment is held until bond matures. So the premium bond and the discount bond in this example have the same average return. And aside from that, so since we mentioned about YTM, now let's try to distinguish it from holding period return. So holding period return is also a measure for return on revenue, but it's for different duration. So it's return on revenue over a particular investment period. And the holding period return will be depending on the market price of the bond at the end of the holding period. Let's talk about the interest rate risk measurement and interest rate risk determinants. Proposition 1 says that bond prices and yield to maturity are negatively related. So this is just about the inverse relationship we just discussed in previous slides, which is the inverse relationship between bond prices and market interest rates. If we look at this example figure here, on the x-axis we have change in yield to maturity denoted in percentage points, and on the y-axis we have percentage change in bond price. So for all four bonds, bond A, B, C, and D, their curves on the figure are all downward sloping, and this indicates that for all of them, there are a negative relationship between bond prices and the yield to maturity. Now let's move on to proposition 2. So for proposition 2, it states that as bond maturity increases, the price sensitivity to changes in yield to maturity would be increasing. We also explained why the increase in maturity would increase interest rate risk also in previous slides. And more specifically, if we want to check this proposition on this graphical example, let's look at the curves of bond B and bond A. So bond B has a longer maturity of 30 years, while bond A only has a shorter maturity of 5 years. And all the other characteristics of them are the same. So we can see that the bond B's curve is much steeper. So this indicates it indeed has higher price sensitivity to any changes in interest rate. Now we can discuss about proposition 3. So for proposition 3, it says bond prices are more sensitive to yield to maturity the lower the coupon rate. First, let's look at the graphic example here. So we can compare the bond B's curve with bond C's curve. Bond B has a higher coupon rate of 12%, while bond C has a lower coupon rate of 3%. And again, we can see that bond C has a much steeper slope, meaning that bond C's price sensitivity to the changes in interest rates are much higher than the price sensitivity of bond B. Let's try to comprehend the reason behind proposition 3. So why would we be having a higher price sensitivity when we have lower coupon rate? So the answer is that you might consider the price sensitivity itself as a weighted average of the sensitivity of the terms in the bond pricing formula. Like remember the discounting formula we talked about. So that being said, a lower coupon rate means that there are lower weights assigned to the discounted coupon terms, and also correspondingly, this means that there will be a higher weight assigned to the discounted principal payment term. And as a result of that, because we know that the principal payment term actually has the highest sensitivity to changes in interest rates. Therefore, because we are placing a higher weight on the most sensitive term, this means the lower the coupon rates, the higher the price sensitivity. Proposition 4 simply says that the price sensitivity will be higher when the current yield to maturity is lower. Those are determinants of interest rate risk, but how do we measure interest rate risk? The answer is we can resort to Macaulay's duration. And by definition, Macaulay's duration is just a weighted average of the times of each payment, with the weight being the fraction of the discounted payment over its price. So more specifically, we have the weight WT being calculated as CFT, the cash flow of time period T, divided by 1 plus the discount rate raised to the power of T. So this numerator here, this is a discounted payment at time T. And we use that numerator divided by the bond price. That leads to the weight we are talking about. And then to calculate the Macaulay's duration, we use WT times the corresponding T of that period. And then we sum the products of each period. That will lead to the Macaulay's duration. An alternative measure is modified duration, and to obtain modified duration, we just use Macaulay's duration divided by 1 plus yield to maturity. And sometimes we directly call Macaulay's duration as duration. Yeah, that's how we quantify interest rate risk. One more thing I forgot to mention about Macaulay's duration is that we previously in the previous slides we discussed about its its original form, its definition. Actually, if we do the mathematical transformation, we can obtain this alternative form, alternative expression of Macaulay's duration. And this equation here means that the proportional change in a bond's price will be equal to the negative of the duration times the proportional change in 1 plus yield to maturity. So duration is just an approximation of interest rate risk. Now let's discuss about the determinants of duration, which should just be the determinants of interest rate risk. So for rule 1, it says zero coupon bonds duration is just a time to maturity. How can we obtain this judgment? We can just resort back to the original definition for Macaulay's duration. We know that it's just a weighted average of the times of each payment. And for zero coupon bond, there is only one payment, which is a lump sum principal payment at the maturity date. And so the payment date is a maturity date. And also we know that the weight placed on this payment should be 100%. So therefore, its duration should be equal to 1 times the maturity time. So the duration should just be the time to maturity. And rules 2, 3, and 4, it just resemble the impacts of a coupon, of the maturity time, and also of the current yield on the market interest rates. And for rule number 5, it states the duration of perpetuity. So we can easily obtain this 1 plus yield divided by yield as a duration by resort to the second calculation formula we showed about the Macaulay's duration. So one final thing today, it's about bond rating classes and credit default spreads. So as we discussed previously, credit default spreads are just measurements of credit risk levels. Therefore, for AAA bonds, so those bonds with very high quality, as we can see in the figure here, those bonds have the lowest credit default spreads. And on the other hand, if we look at the high quality bonds, the BAA bonds, which have relatively lower ratings than the AAA bonds, they would be demonstrating relatively higher credit default spreads compared to AAA bonds. And yeah, that's pretty much the content today. Thanks for attending the lecture. Thank you, guys.